So, you're moving to a new country. That is an incredible adventure. But, amidst all the excitement of packing and planning for this new chapter, there's this huge financial piece of the puzzle you just can't afford to ignore, and that's your relationship with the Canada Revenue Agency. So in this explainer, we've put together the absolute essential financial checklist to help you manage that relationship and make sure your departure is as smooth as possible.
We are going to walk through a really clear step-by-step guide for handling all your tax obligations. And let's be real, getting this right isn't just about avoiding a major headache, it can literally save you thousands, and I mean thousands of dollars. Let's make sure you're totally prepared.
Okay, first things first. Before you can even think about your taxes or anything else, you have to figure out how the CRA actually sees you. The single most important question you need to answer is this: will you officially be considered a non-resident? This one status is the foundation for absolutely everything else we're about to cover.
Now, one key thing to get is that there isn't some magic switch you just flip to become a non-resident. It's not that easy. The CRA kind of looks at the whole picture, and they're really focused on how completely you've severed your ties to Canada. They're going to ask things like, did you sell your home here? Did your spouse and kids move with you? Did you sell off big stuff like your furniture? Are you building a new social and economic life somewhere else? The more of these ties you've cut, the stronger your case for non-residency becomes.
So, once you've figured out, okay, I'm leaving, a few things need to happen right away. Think of this as your immediate, gotta do it now, financial to-do list.
Timing is everything here. First, you'll need to get on the phone with the CRA to stop any benefits you're getting, like the child tax benefit or GST credits. But the most critical deadline is this 60-day window. If you've ever used the Home Buyer's Plan or the Lifelong Learning Plan, you have just 2 months from the day you leave to repay whatever you still owe. If you miss that deadline, whoa, the entire outstanding amount gets added to your income for your final tax year, which could mean a really, really nasty tax surprise.
A question we see all the time is, so, what happens to all my stuff back in Canada? Specifically, what about your bank accounts and your investments? Let's break down exactly what you need to know about the assets you might be leaving behind.
So let's look at the two big ones, your TFSA and your RRSP. And the good news is you can keep both of them. For your TFSA, the rule is super simple: no more contributions. Any money that's already in there can stay and keep growing tax-free, but you just can't add any more to it. For your RRSP, while you technically can still contribute, it usually doesn't make any sense if you don't have Canadian income anymore, because you won't get that all-important tax deduction.
Now, for any income your Canadian investments spit out after you leave, like interest or dividends, there's a special tax you need to know about. It's called a non-resident withholding tax.
And the default rate for this tax is 25%, yeah. Your bank and your financial advisor are actually required by law to automatically withhold this amount and send it directly to the CRA for you.
This 25% tax hits a whole range of passive income, everything from the interest your bank pays you to dividends from your stocks and even government benefits like old age security and CPP. But, and this is a really important but, this rate is not always set in stone. Canada has tax treaties with tons of countries that can actually lower that 25% rate, sometimes by a lot. So it's absolutely essential to check the treaty with your new home country.
All right, let's talk about the big one, the one that causes the most stress and confusion for people leaving Canada. It's officially called a deemed disposition, but pretty much everyone just knows it as the departure tax. This quote really just cuts right to the heart of it. The moment you become a non-resident, the CRA basically pretends that you sold many of your assets at whatever their market value was on that day, and then you have to pay capital gains tax on any growth. It's a pretty scary thought, right? Especially since you haven't actually received any cash from a sale. But take a deep breath because there's some very, very good news here. This departure tax does not apply to some of your biggest assets. As you can see, things like your Canadian real estate, your RRSPs and other pensions, and life insurance policies, they are all exempt. For most people, this is a huge relief, and it means the departure tax won't be nearly as painful as it first sounds.
So then, what does it apply to? Well, typically it's things like stocks or mutual funds that you hold in a non-registered investment account. Also, if you're a business owner, it applies to the shares you own in your private company. So if you do have significant investments outside of your RRSP, this is something you definitely need to prepare for.
Okay, now for a really important what-if scenario. What happens if you keep your Canadian home, you become a non-resident, and then you decide to sell it down the road? This is a totally different situation from the departure tax, and the rules here are absolutely critical to understand.
You have got to look at this slide carefully. The difference is just staggering.
By default, if you sell your $400,000 home as a non-resident, the CRA requires a 25% tax on the entire selling price. That's $100,000. But if you file the correct forms ahead of time, you only pay tax on the capital gain, so the increase in value since you left Canada. In this example, that's a tax bill of just $2,500. $100,000 versus $2,500. It all comes down to filing the right paperwork.
We're almost there. We're in the home stretch. The last major step in this whole process is filing your final Canadian tax return. And just so you know, this isn't just a regular return, it has some very special requirements.
On this final return, a few things are absolutely critical. You have to state your exact departure date. Your personal tax credits will be prorated for the number of days you were actually in Canada that year. And here's a big one you can't forget. If the total value of all the property you own is over $25,000, you have to disclose it all on a special form. Missing this little detail can lead to a penalty of up to $2,500, so it's a detail you just can't afford to miss.
And there you have it. From figuring out your residency status to managing your assets, navigating that tricky departure tax, and filing that final return, you now have a clear blueprint for a financially smooth departure from Canada.
You know, following these steps ensures you're leaving on good terms with the CRA, and that's going to save you a ton of potential stress and money. So you're prepared for the move itself, but the real question is your financial plan truly ready for your new life abroad?